Hi, everyone. Welcome to the Bloomberg Intelligence Industrial Analyst Call. My name is Christina Fury. I'll be your host.
Hi, my name is Mustafa Okur. I cover electrical equipment.
I'm Karen Ubelhart. I cover large cap industrials and rental equipment.
And Chris Cellino covering U.S. machinery.
Welcome, everyone. We're going to touch upon a bunch of different topics today. And Mustafa, let's kick it off with you. I know there's been a election that just happened in Mexico, and just curious on how that's going to impact some of your names and your coverage.
Sure. So, Mexico is a big nearshoring and manufacturing hub for a lot of U.S. industrials, and that includes some electrical equipment makers, both large and small, so ranging from Acuity, lighting company, all the way to Vertiv, which is receiving a lot of interest now and trying to expand capacity to serve data centers, all the way up to big names like Eaton. And the election results, they were not a huge surprise. So the Morena party was expected to win the election. They have left-wing policies, and the president-elect, Claudia Sheinbaum, is a continuation president. So a lot of the policies of the ex-president are anticipated to continue, but that includes substantial increases to the national minimum wage, which went up by 20% on 1st of January this year, and similar raises of 20% are likely for the next 1 or 2 years. So we took a look at that scenario with our economist, Felipe Hernandez, and we put a note out saying basically the wage differential to US manufacturing could close in the next couple of years. Having said that, we don't think the tide of investment into Mexico is not going to go away. And there are two big reasons for that. The first one is that the current average manufacturing wage in Mexico is a tenth of the wage of an average US manufacturing worker. So there's a big gap there. And the second factor is geopolitical reasons, right? So we had COVID, the supply chains got disrupted. A lot of investment now in the US for, driven by legislation like the IRA, and capacity is tight. So that's going to continue as well. So overall, we think the story doesn't change massively. It's just the cost benefit to the big electrical companies, big and small, is not going to be as much.
Very interesting. And I know you've had a lot of investor days happening in your space too, ever since, between the quarters, right? Everyone comes out, the management team. So can you highlight some of the key takeaways, maybe starting with Hubble?
Sure. So Hubble is basically a story of a slowdown. They had massive pent-up demand after pandemic-induced shortages, and they averaged 12% organic growth since their last investor day. That's not going to repeat, so they put out more reasonable growth expectations, which were still slightly higher than history, so mid-single digits. The surprise there was more on the M&A side. So they basically pledged to spend $2 billion on acquisitions in the coming years. If you look at their sort of EV to sales multiples of recent deals, that implies adding about $700 million of revenue, 2 to 3 points a year. Typically, this company acquires bolt-on companies, spends a couple of hundred million. Last year, they acquired Systems Control for $1 billion. We think going forward, they're looking at deals that are sort of middle of the road. So it's probably hard to find deals that are the size of Systems Control, but then they're going to try and acquire more and spend a little bit more than the typical 200-300 million they spend on acquisitions. So that was one positive surprise, I would say, for their fundamentals. And the other good thing is they're targeting margins, and this is a topic that's going to repeat for the other companies as well, maybe. A lot of 80-20 principles to drive margin, especially in their electrical segment, which is lagging their larger utility segment, and they're doing some reorg there as well. Finally, realigning the sales force after sort of realigning their cost and operations by end market. So like renewables, sales for renewables, data center for data center, as opposed to organizing them by product group, which could sort of result in some inefficiencies when you're targeting a large project. So yeah, the overall not a massive surprise. It's just on the growth side, they will rely more on M&A.
Sure. And also Xylem is also one of the companies that I got to actually go for you to the
Yeah.
Investor Day. And I got to see all the cool products, like their renewed water of beer, basically, is what they offered us. But more importantly, their strategic initiatives and all of their refocus after the M&A of Evoqua. So just wondering your view on what you think, if their new goals are achievable and maybe kind of how the path to get there. Maybe what's the biggest risk in like which businesses you
Mhm.
see?
Sure. So the path seems achievable, although it has some risks from execution, namely from two places, right? So the first one will be the expansion of Evoqua internationally, and they may need to do some deals in the new water solutions segment that they've put part of Evoqua into. So there is some risk there. They need to do the right acquisitions, and they need to be able to scale them up internationally. And the other risk, I guess, is the majority of the growth will come from the measurement and control solutions segment, which is basically smart meters, analytics, metering. So there, the risk is that it's currently growing at elevated rates on the backlog, and there is a risk that the orders may slow down substantially or decline in the second half. So they may not be able to feed that backlog going into next year, which would result in a sort of slowdown and potentially missing the targets in 2026, 2027. Having said that, there is a big upgrade cycle in parts of the market. So water was the example that actually Hubble gave. They compete with Xylem in the smart meter arena with their Clara business. So I think overall they could still hit their targets. It's just if there's a big slowdown potentially with the macro and the utilities get spooked, then those orders could be delayed into next year, and then the target could be stretched out.
And the focus on margins, I know you mentioned 80/20. Xylem's also starting that process as well. Do you
Mhm.
think that they have a lot of room for margin expansion?
It seems like they do, right? Because they mentioned that a small portion of their products in some of their segments actually drives more than 100% of the profits, right? So that means they have a bunch of product lines that are loss-making. So they will try to raise the prices on those products, which will improve the margin, maybe drive out some customers, but they've reached that stage now in their sort of journey of digesting Evoqua, right, where they have to streamline. So they don't really care. So they will either price out their customers or just, drive the mix better. So I think, yes, there's a lot of room there.
Great, thank you. Speaking of great operators, Karen, I know Parker Hannifin also had an investor day this over the month of May. Any big key takeaways on their new targets that they set out that you can share with us?
First of all, Mustafa, tell them to do product pruning. That's what ITW did with their 80/20.
Yes.
They just got rid of a lot of product lines that were loss making, and it hurt their organic growth a little bit, but it helped their margin. And so you can just tell management that.
Yeah, that's the aim.
Yeah. So on Parker Hannifin, they have an investor day every couple of years. This year they raised their targets. They had their long-term targets were through 27. Um, their prior long-term goals. They hit the goals in 24, 3 years ahead of expectations. So they rolled it forward. Now their long-term goals are 24 to 29. They raised all their margin goals, which are already very high. They did not raise organic growth or EPS, which really doesn't make sense since they raised the margins, and they do have a mid-single digit organic growth. So expectation. So I think the that is a conservative assumption, and they will probably exceed their revenue growth expectations of 4 to 6% and their EPS growth expectation of 10%. There is, because there's still room in Meggitt, there's still room throughout the company, and they have this continuous improvement process, which they call WIN 4.0, and it's just it's a continuous improvement thing, like a lot of these other ones are, but it's quite successful. And there is still room to do more of that. So the targets were raised. People were disappointed that they didn't raise the organic growth number, and the stock has actually been weak since that, but it had a heck of a run. So I think it had a lot of expectations built into it going into the investor day. The second point is on capital allocation. This is a company that, when I covered it a long time ago, they did many, many tiny deals. Well, in the last 5 years, they've stepped it up and done 4 large deals to reconfigure the portfolio away from being IP driven or ISM driven. They had a largely a short cycle business, in 2015, and now they are moving more and more to long cycle, and they bought a big aftermarket company, a filter company, and so they've really transitioned the portfolio to be much more stable. They were always a good cash generator. They're even better, and so they expect to allocate $35 billion in over the next 5 years. Dividends, which is very important, buyback, and CapEx is only going to use about 5%. So that gives you, $5 billion. So that gives you a lot of money to spend on large deals. Now, you can't always get large deals, but given what they've done with the leverage on Meggitt, which was a $10 billion deal, very big for them, they paid down the debt way early, and they're ready to do another one. So I think they'll take their time, but I think we're going to see more action on that front. I talked about the long cycle transition, and when they first started this process, they were, all of short cycle was, it was almost half the company, and now it's about a quarter of the company, and the target by the end of their time frame is for it to be less than 10% of the company, and you can really see it in the way their order patterns have gone. The industrial orders have been moderately down, about 4% in the U.S., a little bit more internationally, but the company still beat expectations, and for a string of quarters. So they are able to absorb that decline because it's not as big a piece of their portfolio. And now aerospace, very long cycle, is 30%. So the other important thing on that is an average downturn for them is in orders in North America, 6 quarters, and they've had 6 quarters of decline. 5 quarters in North America, 6 quarters in international. So we'll actually probably see some better momentum in orders going forward. This is a company that executes extraordinarily well, and I put my confidence in them meeting or exceeding their margin goal, well, all their goals, and basically having ultimately to exceed the sales and EPS. So that's Parker.
Just on the orders, Karen, Dover, I guess, also quite prone to ISM or IP in the US, and they had 2 quarters of order growth after several quarters of decline. So theirs have inflected already, so that could be a good read across as well.
Yeah, they're about 4% down in the US, a little bit more internationally. So I think we're gonna get the turn, if not this quarter, next quarter.
Mm-hmm.
And so Parker also kind of changed their end market disclosures in a way, right? And they've highlighted different end markets, so it's not just all clumped into industrials. The one that's fairly small, though, that they still managed to highlight was HVAC. I was wondering if you can, maybe we're going to shift gears to the HVAC sector now, and share a little bit about what's going on in that space. I know it's had a lot of funding from the U.S. government, and I actually have this chart here. I'm going to share my screen as you start talking, and we can maybe discuss what the chart is also sharing with us.
Parker did break down into 6 businesses. They've always been very hard to, other than aerospace, to really decide where their big exposures are, because they make small components for anything that moves. mechanical, electrical, hydraulic. So they basically are ISM, and their North American orders have historically fit very well with ISM. And so it's been hard to know like which are the end markets that really matter other than aerospace. We know their mobile business was important because it was high margin. But other than that, you just had to just say what do you think ISM is going to do? Now they've broken it up into 6 businesses, and they're going to talk about those 6 businesses. Of course, the biggest one is aerospace. Industrial and factory automation is the second biggest. HVAC is a very small one. It's only 5%. I think they called it out because it's hot and it's going to grow fast for a while. And while it doesn't matter that much to Parker, it is a business that has grown even before IRA above most industrial markets, and it's growing more than that now. What this chart that we have here, which I'm very excited to have found, and even more excited that Christina was able to make this a live chart. But IRA is important to the HVAC companies. On the residential side, there's money set aside for both rebates and tax credits for consumers and it's in 2 programs. And one is for energy efficiency moves in your house to make you save energy in your house. You can get up to $14,000 a year benefit depending on your income. And then the other one is changing your equipment from boilers to heat pumps, or that are electrical driven stuff rather than carbon driven stuff. And there's benefits up to $8,000 depending on income from that program. The problem is it's been in place for over 2 years and very little has happened, and it's starting to happen. And that's the important thing. The bottlenecks that they've had, which are largely at the state level, seem to be breaking. And we should see some movement out of, money flowing out of the IRA. Probably some in the second half we'll start to see it. The bottlenecks were that every state has to apply to the federal government to get funding. The government has to review it and then get back and say, we'll give you the funding. And it's a process that takes a long time, longer than we expected. And then they also have to set up an infrastructure at the state level to be able to execute these. Their point of sale rebates or tax credits. The tax credits are easy. The individual does it at tax time, right? But the rebates are more complicated. So we found this chart, and it showed in March there were like 4 states that had even filed, which is the first stage. Then we went back to it and looked in April, and there were 12. And then we went back and looked at May. We're going to look at this at the end of every month, and it's 17. And this chart flashes. First, it starts with March. You can see there's not much light blue. Then you get more light blue. Then you get more light blue. So this says that the process is rolling out. It started to accelerate, and we think that's a positive for the residential side of the HVAC business, which has been slow. Commercial HVAC has been very strong. But Resi has hit all of the HVAC companies, and that this is another. Weak consumer spending was one, and then the delays in this, which are incentives that would drive demand, has also hurt. So it's kind of a double whammy, and it looks like this is going to start to roll out finally, and the Resi demand is probably close to a bottom. So so that's a story on that, and we'll be reporting on this every month, and I hope we continue to see more light blue.
Great, thank you. And speaking of monthly indicators, Chris, I know that Fastenal has some monthly sales that came out today. Can you give us a pulse check on what's going on in that space?
Yeah, the numbers weren't great. Average daily sales were up 1.5% in May. It's a slight improvement from what we saw in April, but really it was because of an easier comp. Sales were again below the historical seasonality for the 3rd straight month. I think by the tune of about 100 basis points in May. So 2Q estimates will definitely need to come down. Probably looking at, a 2% haircut on the top line. And weakness, again, continues to be most acute in their most cyclical and highest margin product, fasteners, which actually deteriorated. They were down, I think, 4% in the month, despite an easier comp. But really, growth continues to be rather anemic across most end markets, products, and regions. maybe not that surprising given some of the macro indicators and the ISM retreating here the past 2 months. But we continue to just kind of be stuck in this industrial malaise with, I would say, so far signs of a recovery pretty elusive.
A market that might be stabilizing though is the ag market. Can you maybe elaborate on what you're seeing there and if there's any positive signs happening?
Sure. Sure. Yeah. I mean, crop prices have stabilized a little bit here, I'd say over the last 3 months. But that being said, we still have pretty favorable growing conditions. Soil moisture is good. So I suspect that we'll see, good yields, which are really going to continue to put downward pressure on grain prices, particularly here in the back half. So I think our view really hasn't changed all that much from earlier this year. There's going to be significant production cuts in the back half of this year. Global ag markets continue to soften, and inventories are really piling up. So there's going to be very significant cuts in the back half to hopefully try to right-size the channel, and ultimately with the goal of producing in line with retail demand in 2025. I think that's kind of where some of our larger concerns lie, in that farm fundamentals continue to weaken. Net farm income is going to be down 27% this year if you adjust for inflation. We seem to be kind of in this higher for longer interest rate environment. Interest expense as a percent of farmer expenses, it's going to be close to 8% again this year, which would be second highest in the last 20 plus years. The fleet age has come down. After a number of years of strong buying. So we're kind of increasingly cautious from a demand perspective heading into 2025. So we see North American large ag probably down at least 15% on the retail side this year, and then probably we're thinking another 5 to 10% next year. Historically, these cycles, they're not 1-year downturns. That's exceedingly rare. So, and we really don't see any reason to believe that this cycle is going to be any different at this juncture. That all being said, OEMs are being much more, I would say, proactive about bringing down inventories and managing the cost structure. So yeah, we just saw, just this week, Deere announcing more headcount reductions. CNH has already come out with 2 cost savings programs. So I think the industry, like I said, a little more disciplined as each cycle evolves. So I do think we end up seeing higher trough margins. But from a demand perspective, we think the challenges continue into 25.
And to round out your coverage, I know you also follow the truck sector. What's happening with the commercial vehicles and what's your outlook there?
Yeah, so this is an interesting market because builds are coming down again significantly in the back half of this year. I think that's pretty well understood by the market. Soft freight environment, rising inventories, some tougher comps. So there'll be a meaningful step down in build rates in 3Q. We kind of expect builds to bottom in the fourth quarter, and then production will gradually start to recover in 25. Really driven by a recovery in the freight markets. We think while spot and contract rates have bottomed and they're still down, they continue to narrow, and expect that to kind of inflect at some point later this year, early next year. You also have better economic growth prospects, I'd say, and then the big elephant in the room is this pre-buy ahead of the 2027 EPA emissions regs. So we kind of see that as a catalyst for growth here in 25 and then also in 2026. I think downside somewhat limited here in the near term, at least for the back half of this year. Build slots are, 3Q is all filled up, 4Q is starting to fill up. We actually had good order numbers this week. Class 8 orders were up 37%, almost hit 19,000, which is a very strong number for a typically slower time of the year. A lot of that was driven by vocational strength, which continues to be, I'd say, a bright spot relative to the long haul on highway market, which is obviously good news for PACCAR. They're the market leader in the vocational segment. So long story short, we see 24 down, very modest downturn, down 10-15% in terms of Class 8 builds, somewhere in that, call it 280,000, 295,000 range, and then really kind of hit the ground running into 25 and 26, really driven by this pre-buy. The EPA is calling for more than 80% reduction in NOx. There's also an extended warranty component to this emission cycle. So, we think it could potentially add an incremental $20,000 to $30,000 to the cost of the vehicle. So it's substantial, which is ultimately going to drive this pre-buy. So we're thinking really that starts to kick in the back half of next year. And then we think, 2026, you could see builds, close to 350,000, which was kind of in line with the 2019 peak. I think we struggled to get above that. One, I don't think the supply chain could handle that, and the industry is not going to add a ton of capacity just to meet this pre-buy. So certainly the outlook looks pretty encouraging once you get beyond these next 6 months or so. But we'll continue to watch order trends and see if inventories continue to come down here in the back half of the year.
The emission standards, is that like everything that's on the road has to meet the standards by 2027? So they have to upgrade their whole fleets, or is there like a slow phase out of whatever is existing?
No, it's a national standard, and it's for new vehicle sales, right? So anything sold after Jan 1, 2027 must be compliant with these new regulations, which are, like I said, a more than 80% reduction in NOx. And then the biggest uncertainty, I think, still at this point is what's going to be the extended warranty component and how OEMs are going to price for that. That's still a little bit up in the air. We're still, 2.5 years out, which I think is the earliest we've ever talked about a pre-buy. But if you look at a lot of the performance in the OEMs and even the engine makers, they've moved pretty aggressively this year in anticipation of this big pre-buy.
Chris, is 80% NOx reduction sounds huge. Are these engines going hybrid, or is there a massive tech leap? You did mention the cost is going up a lot, but how are they achieving it?
Yeah, the biggest cost component really is going to be the warranty side. I think from a hardware, just strictly from the hardware upgrades, I think it'll be less than half of probably that increase. So they've made a lot of the OEMs, which are vertically integrated, as also Cummins. They're well along that pathway to meeting those regulations. I suspect this is probably the last NOx reduction we'll get, and then it now becomes, do we get some kind of mandate in terms of zero emission vehicle adoption going forward? What does that look like, right? I mean, is it battery electric? Is it hydrogen fuel cell? Is it hydrogen combustion engine? I suspect, like I said, this is probably the last NOx reduction that we'll see in the U.S.
Very interesting.
Yeah. Thank you so much for everyone's insights and the good conversation as always. That's all the time we have for today. We'll see you next time.